Okay, students, so we start with the new beautiful another standard. Every standard is beautiful only in itself. Something is more, something is okay. Somebody may like it, somebody may not like it. This again, I like it. I like everyone. Ind AS 36, which is impairment. Now, what is this impairment? What is the concept of impairment? What is the impairment? Impair, have you heard? Fall in the value. Now, impairment means there is a fall or a reduction in the value which can happen due to external forces or it can happen due to internal things. Understood, no? So, we are going to discuss this chapter under 4 groups. So, again I will remind you, any questions, 90% of the questions will be revolving around these 4 areas. Out of this, your impairment of the CGU is a very important aspect. Maybe, probably, because all these things are connected with that. It starts from the first part is a very simple exercise. It doesn't take time. Now, what is the difference between impairment and downward evaluation? And before that, what is impairment? See, impairment goes something like this. Any asset is valued based on what? Its ability to earn cash. Say, for example, there is one person. How he is valued? We discussed it. That person's value in the society is based on their ability to earn the cash. It can so happen that he meets with one accident or he gets an illness, life-threatening illness. What it does? Both the instances are going to reduce the capability of the person to earn the cash. And from that time, no insurance company is going to give him full value insurance. Or if at all any insurance is going to give, they will charge high amount of premium. It indicates a risk. That's why impairment is a very risky thing, which the companies want to avoid, because the moment any asset gets impaired, investors will discount it. Investments may not flow there. Same like humans, no? So it all goes with, that's why the companies are very much interested not to impair their assets. So it becomes a financial statement misstatement. And why they don't want to do? Because they don't want to tell that outside world, look, my ability to earn the cash has reduced. Then venture capitalist investors will pull out their money, put it somewhere else, and you become a cash trap. See, for business, cash is the blood. If you take that blood out, business is going to die. Followed, no? That's why they will try to see to it that their asset is not going to get impaired. So our objective as an auditor, not to force any impairment. Look for the indicators. Look whether in reality, because when we talk about true and fair, we are talking about the truth in reality. Have you got impaired? If yes, tell the status. Because it is not your responsibility to tell. It is the responsibility of the management to bring it out to the in front of the investors. It's whose responsibility to prepare the financials? Management's responsibility. So the materiality, conceptual framework for preparation and all, it is not given to us. It is given to them. Ind AS is given to them. They have to follow it. For me, it is a benchmark, comparison, to see to it that whether have they done this as per what has been told to them. So for this, to tell that, should I not understand the rules? That's what we are learning now. Because if I have not understood it, how I can judge whether somebody is doing properly or not? He may be hiding it and people are trusting us. Sir, whatever you say, I go with you, because they don't understand what they are doing. That's the role what we play here. Now, how impairment is different from downward revaluation? Both are same. Have we come across downward revaluation anywhere? PP. Is downward revaluation and impairment same? Then what is the difference? This question, in fact, you should ask me. And it shows me that you are very much curious. So many questions are popping up in your mind. I just see, I told you yesterday I was somewhere, I was talking about curiosity. You know how powerful that curiosity is? One day I was sitting, okay, and watching one mosquito was flying, and there was one, this what is that called, lizard, trying to catch that mosquito. That mosquito went like this, it tried to escape. This side one more lizard was there. It escaped from that lizard also. It didn't dare to come towards me, one more big killer. It would have come, I would have killed it instantly. I'm just observing. Then I suddenly observed, this poor mosquito, from how many predators it has to save its life? Just one question came to my mind, simple question, correct? And I thought, that means, how come that mosquito is still alive? How their santan or santati is still alive now? Generation is there. Because so many people are there waiting to kill that mosquito. Once suddenly I thought, I started to put in the Google, how many eggs mosquitoes will keep? Mind-blowing number, some 50, 60,000 something, big number. Then I started to what they eat. Then I came to know that mosquitoes don't drink blood for their survival. They eat something greenery on, that's why you find the mosquitoes when there is water, not water, they stagnant water to keep their egg. They are there next to this thing, plant and all, no? When you go in the evening towards the plant, you see a lot of mosquitoes there because that is their food. Then I got surprised, why they drink blood? Then I came to know, see the pathetic condition of mosquitoes. Sorry? Do you know first of all which mosquitoes will drink our blood? Which mosquitoes, male mosquito or female mosquito? It's the female mosquito. I didn't knew this. I thought mosquitoes drink blood too for their survival. Then I came to know mosquitoes drink blood for the reproduction. That a female mosquito is going to drink our blood. Followed, no? And I am going to kill it. Is it that mosquito's mistake? I have to blame nature there. Nature has made that mosquito like that, no? If a mosquito would not have harmed me, will I go and kill it? No. See, there are a lot of things, students, and within that 5 to 10 minutes, so many things I understood about mosquito which I didn't thought also. Just started with one question. How did this mosquito survive? So, when you read, just see, curiosity has no this thing, okay, no reward. Nobody is going to give one job or give any money for asking curious questions. But the curiosity, no, it's going to fulfill you with such a pleasant happiness, okay, which somebody has told me, feelings cannot be expressed. Feeling has to be felt. I cannot say, how happy I am. I can express in my word, but I cannot make you feel what I feel. Followed, no? So that's what I tell. Please ask questions. Develop it as a habit so that eventually it will turn out into a curiosity or whatever habit. And you see that so many questions will, in fact, this question, one curious student asked me, which I am asking you. But a downward revolution is also uncertain, no? Need not be. I'm doing for the first time now. Evaluation I'm doing for the first time. First time itself I may go for downward revolution. What is the equation for downward revolution? What is the equation for downward revolution? Carrying amount is more than fair value. What is the equation for impairment? Carrying amount greater than recoverable amount, which is higher of fair value, value in use. That means I use this similarly somewhere, one more extra addition. This means almost like those are two breeds now, belonging to the same species, but they are not same species. Understood? No, because see, if you see, no, almost this equation is nothing but your downward revolution equation only. What is the difference? That means why they should get me a standard like Ind AS 36? Rather than they could have told, no, go to Ind AS 16 only, do downward revolution. If your value is less than that, go and do that. Nice question, no? No, I am not the originator of this question. One curious student asked me this. I was very happy. Okay, understand the difference. Accounting impact is same. both you charge to the P&L account. However, when it happens upward revaluation, the previous loss in the P&L is reversed, okay, at full fair value. And then the balance you charge to OCI. Generally, upward revaluation you will take to OCI. But this time, whatever you are charged to the P&L, you recover and balance you take. But when upward impairment reversal happens, impairment reversal would restrict your reversal up to the would-be carrying amount. You cannot increase more than certain limits there. Then revaluation is a policy choice. If you don't want, you can go for a cost model. Impairment is mandatory based on the indicator. If you would have given a downward revaluation, no, you would have opted not to do it. Then asset in reality got impaired, but you will not recognize it because it's your policy choice. You will always opt for cost model. But impairment is not a policy choice. I want to give that effect. And if you follow a revaluation model, then impairment will not affect you. Or even though its effect is minor, because always you state your assets at the fair value there. And fair value and recoverable, a minor difference is there. But between a cost and a fair value, there can be a huge difference. And last one, goodwill does not become part of the CGU in evaluation, but goodwill is allocated to CGU for impairment because goodwill itself is an intangible asset. As per accounting standard, you are split into different 10 years or whatever, goodwill on amalgamation. But under new Ind AS, goodwill is impaired every year, means tested for impairment every year, but it is not amortized. Have you understood the difference? In amalgamation, you remember in a interlevel, goodwill on amalgamation, what you used to do? Split for 10 years, no? There is no treatment like that. Have we done this 110? No, 110 came with the impairment there. 98 rupees impaired. Then we saw whether it is a full goodwill method or partial goodwill method. See, understand one more thing. Every single chapter are complete in itself. It will not touch other chapter. It is only L3 level questions will touch other chapters. That's why in 110 when we learned every time they used to tell me the amount of impairment. But the calculation is coming from 36. And there is only one question on impairment which I didn't share with you, I have yet to share, level 2, where 110 consolidation you need to do, but for working note, you have to prepare an impairment by calling Ind AS 36 working. That is L3 question. And that weightage is only 15% in your CAFinals. That means any questions they ask you, around 60% of the question are L2 level. That means if you look at one chapter, they will ask you on one concept. Probably in that one chapter, they may take other aspects and fit in there. That's why if you see the pattern till now, whatever we have done, they can complicate it, but they don't do it. But one aspect they will complicate it in such a way that itself looks complicated, but it's one aspect of one chapter. You got that clarity? So understood the difference between impairment and revaluation, if anybody asks you. Impairment is simple. Impairment is a mandatory. Your downward revaluation is a policy choice. This is you tell enough. Policy choice. If you don't want to do, don't do it. But impairment, there is no choice like that. That's why if they have opted for revaluation model, impairment doesn't affect such organizations much. But if somebody has opted cost model, impairment, the day impairment is going to happen, no, their P&L looks very beautiful, red. Because big amount of impairment loss has hit their P&L account. So somebody has to take a conscious decision, which type of accounting, what my investors expect. So better should we go for revaluation? Then the moment you go for revaluation, upward revaluation, I will not permit you to take to P&L account. That is outside P&L. Followed, no? Anyhow, let us talk now only concepts about impairment. An asset is impaired when the book value exceeds the recoverable amount. That means your book value is more than what you can recover. And I told you, any asset in the world, there are only two ways you can get the cash. How? Use it or sell it. Now, what a person with a commercial common sense will do? He will say, see, by using an asset, I will get present value of the future cash flows 100 rupees. Or by right now selling, I will do 100, I will get 110. What I should do? sell it. If I get 200 rupees by using it, 180 rupees by selling it, what I should do? That's what they said. Recover amount is whichever is higher of fair value or value in use. Because a person with the commercial common sense would have done the same thing irrespective of what you do in reality. Followed, no? That's why they say whichever is higher is the recoverable amount. You are clear, no? So we are going to use one new terminology called recoverable amount. Recoverable amount means the amount what you are going to recover from this asset. How? Either by using it, we call value in use, or by selling it, which is fair value. And whatever any person will do, whichever is high, that decision is going to take. And that becomes the recoverable amount. And if it is less than the fair value, the difference between these two will be your impairment, and you will charge to the P&L account with an entry, impairment expense account debit to asset. That's the crux of this impairment. Simple. So you have to calculate, maybe they will trick you with this. Okay, they will give you subsequent impairments, depreciation. These are all the concepts are going to fail. Now what is fair value? Fair value is always used with the cost to disposal. It's governed by 113, and cost of disposal includes legal fees, stamp duty, etc., removing of the assets, dismantling. Sorry? Okay, yeah. First of all, are you clear about this impairment concept? Impairment means whatever value you assume that this is worth. In reality, it is not worth, because in the future, it is not, or right now, it is not going to give you that much of cash. So the difference between the book value and that what is worth, you write off. So what is the meaning of fair value here? So fair value is not fair value, it's fair value less cost of disposal. Like if any legal fees is there, stamp duty is there. So you may get 100 rupees market price, but you have to incur 2 rupees stamp duty. So net how much you get? 98. So 98 is your fair value. Sorry? It's like an NRV, not net realizable value, that we call for inventory. It's like, okay, fair value less cost to sell. This terminology we use in Ind AS 41, agricultural assets. Same logic we'll use there. Okay, now what do you mean by value in use? Understand this. Value in use is the present value of all the future cash flows. That means future cash flow I may get in different years during the life of the asset. What I am supposed to do? Discount it. At what rate? Pre-tax rate. So alternatively, you can use weighted average cost of capital or incremental borrowing rate. How do you calculate weighted average cost of capital? First of all, fair value is clear to you, everyone. Fair value means value, market price. Market. See, again, I told you it is governed by 113, and 113 says that fair value means the price at which you are willing to pay. If I am the seller, at what price you are willing to pay me? That's a fair value. Then there are more conditions to it. Okay, if it is a non-financial asset, then it's called highest and the best use. Let us not get into it. Once you understand 115, then you understand fair value better. Okay, we will do it probably in next coming days. We will do 113 also. So for time being, understand simplicity is a fair value means market price. But a market, when you sell at a market price, you will not get the market price because you have to incur certain cost like stamp duty and all, which will reduce your market price. So what you realize is less than fair value, because these are all your transaction costs which you need to deduct from the fair value. Now what is value in use? It is the present value of the future cash flow. The moment you say present value, you need a discount factor. Which discount factor will you use? CAPM model? AFM? Will we use that? Or will we use it, what is that called, weighted average cost of capital? How do you calculate weighted average cost of capital? KE into weight of equity plus KD into weight of debt. What is weight of debt? What is the formula for weight of debt? Debt divided by debt plus equity. What is the weight of debt? Debt plus equity. Equity, weight of equity is equal to equity divided by debt plus equity. Oh, no, simple. So I am just reminding you, because just such question they will not ask you. Worst case, You know how to calculate the weight of cost of capital, and it is a pre-tax rate, because tax you should not consider here. Now what it should include? It should include your sales, cost of sales, residual value, because this is also a cash flow, maintenance cost, and if you have apportioned anything of the corporate overheads, that should be part of your cash flows. If you want to calculate present value of the future cash flows, you remember in AFM, there is a international financial management. There we come across this type of problem, international financial management, where they give me the sales, they give me the cost of the production, they will give administrative cost, I have to deduct it, cost, then I will get FCF, free cash flow after tax, capex you minus, and finally you multiply with the discount factor and find out the present value and get the present value. That is this. But from an accounting point of view, see, that is from AFM point of view, leave it, think only that. But from accounting point of view, you should include only these elements. You should not include cash receipt from the customer. Then you say, sir, sales is not a cash flow. No. Cash receipt from the customer is a cash flow. But sales is not a cash flow, right? Cash receipt from the customer is a cash flow, no? So when I talk about present value of the future cash flow, should I discount cash receipt from the customer and its present value, or sales to the customer and its present value? And now my question is, which one I should take to find out the present value? Sales. Again, don't take it, becomes double counting there. Already sales you have considered. Again, cash received from the customer also you are going to consider, no, it is a double counting. So exclude this. Payment to the liability exclude, because COX you have considered. Cash flow from future restructuring for which you are not yet committed. In AFM you might have done this. Account says, Baba, Ind AS 37 says you don't have any commitment. Not dismantling cost is a liability for you. That is sure shot you are going to do. Today you think after 2 years I will set up one extra plant and get one extra efficiency. Maybe AFM will consider that assumption, but account says no. If you are not committed, we are not going to consider that for your cash flow calculations. So what cash flow you will calculate as per accounts versus what you do as per AFM may be different. Leave it, both are different disciplines. Here we have to go with certain set of accounting practices and principles. There we go with the different practices and principles. Now, cash flow from the improved assets performance, you are going to tell, look Baba, today it is that person is only a kid. After 10 years, that person is going to become some world-class leader of one company. So please value that as, yeah, AFM we would have valued that. Future performance of the asset we would have considered. But in Ind AS, unless it is demonstrated, we will not consider the future improvement in the assets performance. Followed, no? And cash flow from financing activities we are not going to consider. Why? Because we are discounting it. That's why time value is already considered in the financing activity. So again, interest income, future, what you are going to get, no? Don't consider, because all the cash flows you are discounted. See, what we are trying to find out here is not your cash flow from other activities. We are trying to find out cash flow from operations. Why? Because you are using this machinery to manufacture finished goods so that you can sell that finished goods and get the cash flow. Why you want, by using that cash flow, you have kept some FD in the bank, and FD bank is going to give you interest. What that has to do with the life of this asset? Have you understood? So when we are calculating value in use, we are just focused on this asset's capacity to earn cash. Taxation you ignore. Income tax receipts should not be. That's why we take pre-discount rate. Now when we do these inclusions and when we do these exclusions, we get the present value of the future cash flow only and only this asset is capable to earn. Not any other components there. Not inflated value, because people are interested to inflate by telling some story. Sir, after 2 years, this asset is going to perform super. Let that day come, no? Then we'll upgrade it. Why you want to do it right now? Have you committed? Can you demonstrate? Because accounts go with that, no? We want demonstrations. We want the obligations to be sitting on your head. Then only we'll do it, because we are conservative. Your AFM is aggressive. Yeah, In financial management, you have to be aggressive. You have to take risk. In accounts, we don't take risk. We take it on a conservative basis. Followed, no? So that's why this way we calculate. What if we have got foreign cash flows? In AFM, we have got two approach to find out what is that? If you have got subsidiary in the foreign country, in International Financial Management chapter, that subsidiary is going to earn the cash flows in dollars. Now you have to find out the present value and take one NPV decision, whether the project is okay or not. There are two approaches to find out the NPV in AFM. Which all those methods? It is called foreign currency approach and home currency approach. In foreign currency approach, that foreign currency cash flows are converted at then and there itself by future foreign exchange rates. That means foreign currency is converted into home currency and home currency's NPV is checked. In home currency approach, okay, you do find out the, this is home currency approach. Foreign currencies you convert into home currency and home currency's NPV you check. In foreign currency approach, you find out the NPV in foreign currency only. Then using spot rate you convert and find out which method FR will permit. Foreign currency approach. They will not permit home currency approach. Because in AFM, what we do, we find out future exchange rates. How? Using IRP theory, interest rate parity theory. We project what will be the exchange rate next year. Our account says, Baba, don't get into all those things. Don't try to project the exchange rate next year and try to find out the NPV. Do one thing. If you are projecting the foreign cash flows, find out the NPV in the foreign cash flow in their country's currency only by taking their discount rates. You get one NPV and today's spot, are you certain? Convert that NPV into spot, no. So home currency approach is not permitted in Ind AS. Are you clear? Because see, I am telling you, this may look like a small theory, but in examination, they may give you this rather than impairment question. They will give you one foreign currency asset there, and you have to impair that foreign currency asset. Then you should understand which approach to follow. Followed, no? Anyhow, we'll solve the problem, you get better understanding. So you should translate at the end at the exported. What are the indicators of impairment? There are indicators like can happen from the external sources. I told you, no, a person can be met with an accident, which is an external indicator, like decline in the market value, increase in the interest rate, change in the technology, sudden one lightning happened and building fell down, earthquake happened, building fell down. These are all the external sources. Internal sources like obsolescence, economic performance has worsened than expected, significant changes in the use of an asset. You were planned to use the asset in one particular way, you started to use in some other way. So the cash flows are going to change. So these are all the internal indicators. So what the standard says, entities required to test the items at least annually only for 3 items. See, for all other assets, you have to assess impairment only if there is an indication. Otherwise, impairment is not compulsory every year. That every year I will check what is my machine's future cash flow earning capacity, fair value and all. This exercise you need not do every year unless you have got an impairment. That's why in 2020, almost every company impairment testing happened because of Corona. During Corona, the assets cash earning capacity fell down. Why? Because you are uncertain now. How long the Corona is going to happen, how long this particular, what is that called, lockdown will be there. So people must have tested. During mining ban, in our company, impairment testing was done. I was working in Vedanta, mining ban happened, impairment testing, and I was part of that. Where we have to anticipate how much cash flows we are going to earn during the life, what was the recoverable value, future cash, all activity. I just remembered my working of the company. So what you're going to learn, see, and I just landed up. I was working in IT department. From IT department, I came to finance department in last 2 years of my career. The very first job given to me was this impairment. Why? Because one person was about to leave in finance department. That work was vacant. There was nobody else to take over, so I was given out. So I literally worked on this impairment part. I didn't realize unless I solved one question. At that time, it just struck me, Arey Baba, it's the same thing, what I have done in my company. Followed, no? So in that talk, these rules are applicable there. Now, there are only 3 assets for which compulsorily every year you have to test for impairment. One, an intangible asset with indefinite useful life, or intangible asset not yet available for use, or goodwill in business common. If you have got a goodwill in your balance sheet, every year you have to test for impairment. Do you have any example for intangible asset with indefinite life? Patent, indefinite life. Who has given? Patent. Land is a tangible asset, not an intangible asset. Yeah, land with, you could have said with the intangible asset, tangible asset with the infinite life. That also different, huh? But okay, we can reasonably assume. Sorry? I didn't. Side. Copyrights, but okay, you will have in copyrights. After some time, the syllabus got changed. What you will do with this copyright? Who wants your copyright? Which intellectual property? Yeah, very good. That's what, because intangible asset is an intellectual property, or intellectual property is an intangible asset. See, 500 years back, Purandaradasa, no, you know, there is one saint, okay. He came with one song, beautiful song. The song is Anugalavu Chinte. Anugalavu Chinte means, being human, no, we are always, worry is always part of our life. Okay, if this happens, you have got worry. Okay, you think, if I do this, my worry is gone. You get into one more worry. If you say, okay, if I solve that, my worry is gone. You got one. If Purandaradasa had held a copyright for this, no, that would have been a very relevant copyright throughout the humanity, correct, no? It is one, because see, from that 500 years back, and it's still relevant. It is one intangible asset which has got an indefinite life. That's okay, we can assume trademarks. Like your example was correct, copyrights. We will assume that it has got intangible, because if that your work is so beautiful, your copyrights will have an indefinite life, no? That's why, but test every year. Is the syllabus changed? Is your content still relevant? Because the day your contents becomes irrelevant, your copyrights has to be impaired. And what is the value of the copyright? It is coming from Ind AS 38. Book value comes from there. Now, how it comes, we will learn that. That's why when you understand all the standards in totality, no, you will be able to answer anything looking around, how it should be accounted, which value comes from where it will happen, how it will go. Okay, are you clear about the intangible? Okay, your copyright was one of the fantastic example, like logo. Intangible. Unless you perform, it is good. But the day you are not performing, impair it. And test for every year. Are you performing every year? Now, intangible asset not yet available. Oh. Sorry? If it is indicator, even though your machine also you have to test for impairment. See, these items, so every year you have to test. But other than this, you have got a building. Should you test for impairment? No. But if there are indicators, test. Followed, no? And current assets are not meant for impairment. Huh? Why? It is always stated at the realizable value. No? Current assets at what price? At realizable value. Debtors. Should you impair? We can say impair, but it is not governed by Ind AS 36. Debtors impairment is governed by 109. What we call them? Expected credit loss, a beautiful English language. But expected credit loss is nothing but an impairment only, no? Okay. How do you recognize impairment loss? Simple. Charge it to P&L account. However, impairment loss of a revalued asset shall be treated as a revaluation decrease. So if you have revalued and some of the revaluation surplus is sitting in the OCI as per 16 and you impair that asset, you should treat like a reduction in the revaluation. Instead of charging to P&L, first you eat that OCI. That's what it's same like your PP. How both standard can talk differently. That's why both standards should talk same. No, both will. That's what this is the same treatment you would have given for that downward revaluation. With when an impairment loss exceeds the carrying amount, recognize liability. Oh my goodness, what is this new concept? Can it happen? Can it happen that impairment loss has crossed your book value? How? Give an example. Exactly. Yes, you have to dispose now of, get rid of this asset. You have to incur more than what is the book value of it. Is there any example? In fact, this again, student asked me, sir, can you give example? I suddenly remembered next to my house, no, Suratkal, there is one ship which is beached. Have you heard this word called ship getting beached? Beached sound like something word, but in their language, beached means that ship comes to the shore by mistake or whatever it is. In next to my house in Suratkal, one ship, you must have read in the newspaper also, it came on shore by mistake. Now the problem is if it comes to the shore, if it gets beached, then again you have to get it to the sea. First of all, see, those specialized assets should be there in specific places, because the depth of the water below that ship should be so and so. There are certain calculations. So it becomes very difficult for you to again get it back to the sea. Now that asset is lying there from past 2-3 years. Why? Because if you have to take back, the cost what you incur is more than, instead of that you can buy one new ship there. So it is kept lying there. So book value is 5 crore. Value in use is nil. Why? Because you are not using it. See, ship is worth when it is in the sea, not when beached. No. What cash flow it is earning? Nothing. Does it have a book value? Yes, you have spent. Now, fair value less cost to sell. You say, sir, I don't want any money. Please take it. Will anybody take it? No. My cost of disposal has crossed my fair value, because since its value in use is nil, no, people will not take it. And dismantling a ship, from 1 year it is happening, still it is not complete. It is not an easy job, no. So the cost of disposal is more, Baba. Then you have to recognize a liability more than, first consume that book value and recognize liability for a 3 crore, no, dismantling cost. Understood? Yes, in the above case, impairment is 5 crore. That means eat that book value full, and decommissioning liability provision you make 3 crores as per Ind AS 16. So your P&L will get hit by 8 crores now. 5 crore impairment of the book value and 3 crore liability to get rid of this asset. And if you can you say, I will not take this asset? Instantly notice will come, all these fishermen will shout there that diesel is going, we are not able to do this thing. You cannot say no. Your asset, like suppose your car gets broken and on the highway only, it is middle, it is there. Will you say, I don't want this car? You have to take it by spending money, and you have to incur a liability. Negative because what you get by selling scrap, say 10 crore, and to dismantle and sell it scrap, you have to incur 13 crores, somebody, you have to pay someone. Then always what you do, no, you say, let that asset remain there only, I don't want it, usabari. It becomes, in contract terms, it is called onerous contract. Headache. One asset is there, if you touch, you have to spend more than what you recover from that. So you abandon that generally in our day-to-day life also. But you cannot abandon certain assets. If it was in your premises, you keep it idle, no. Nobody will come and ask. But if in somebody's property, if you abandon your asset, which person will permit it? They will not, they will come and catch your neck, no? That's why when you abandoned your asset on somebody's property there, make a liability provision for 3 lakhs, because today or tomorrow you have to remove it. That's why Ind AS 37 also beautiful, students. Once you understand Ind AS 37, perfectly going to fit in all these places, what we are talking. Are you clear now? Is this clear? Liability, when you dismantle, no, you will pay this 3 crore, 13 crore. So you tell that guy only, the scrap seller only, you only take. How? This time he will not pay. When you sell something on scrap, who will pay to whom? See, you are the person, I am the scrap buyer. You are the scrap seller. When you sell some scrap to me, who has to pay to whom? No, but this time you have to sell the scrap to me, on top of it 3 crore you have to give me to take this asset from your premises or somebody's premises somewhere else. Is it not a liability to you? Generally you would have told, no sir, let it remain there only. That's called abandonment, which if it was your property, then you need not recognize a liability. But if it is in somebody's property, you have to recognize a liability with impairment. Are you clear? Very clear? Just recognize, now impairment will result in deferred tax also. In Ind AS 12 we have learned. And if the asset is valued on cost model, impairment expense will go to P&L. And if this asset is applied on revaluation model, it will go to OCI or P&L depending upon where it has gone. And that revaluation and impairment we have already done in Ind AS 12. You remember that, no? Impairment, I don't know whether we have done or not, but wherever you have done an impairment on a revaluation asset, if that revaluation is sitting in the OCI, then you will go to OCI. If that revaluation, downward revaluation happened, it would have gone to P&L. Whatever. Okay, so this is the first part, very simple. So let us just check certain theory, which may not come for your examination, but for your understanding sake. Impairment of the individual asset. There is a cash flow is 100, 200, 300, and the probability is 10%, 60%, 30%. What is expected cash flow? Expected value method. Multiply cash flow with the probability and say 220. See, this is given in your test your knowledge. Till now, no questions have been asked, but one beautiful plug and play question they can frame using this. Don't get confused. With this is what value? 220 is what? In our impairment language, what is the value of this? Value in use. So they may not give you a value in use. Alternatively, they will give you all the information along with this type of information. So working note 1, calculation of value in use. What is the value in use? Multiply all this, say this. Compare this with the fair value, whichever is high. Compare that value with the carrying amount. If carrying amount is more, impairment is going to come. You understood this link? Yeah, we are in different territory now. In 150, I know you are in 115 mood. Means you have to unlearn it. That is not no more applicable. We have to learn new terminologies. And you should think fast with these terminologies. Cash flow is 1000, may be received in 1 year, 2 year, 3 year, and the probability is 10, 60, 30%. What is your expected cash flow, which is value in use, assuming discount rate is 5%, 5.25, 5.55? Alternatively, in another question, instead of one figure of value in use, they may give you a question like this. Again, you need to have a working note and say, look, my cash flow is 1000 every year, which can come with the 10%, 60%, 30% probability. So what is the present value of 1000 3 years from now? At 5.5 discount percentage, it is 851. But am I going to get 851? No, there is only 30% chance that I may get 851. So multiply, your value in use is 892.36. Are you clear? This is more like your simple AFM calculations. See, till now they have not done this, but they may do it. Calculated expected cash flow. Okay, this time you should tell. Estimated amount falls somewhere 50 and 250, but none of the amount is more likely than any other. What is my value in use? Amount, tell me single amount. Because everywhere we used to tell single amount, no? This single amount, 1, how did you get? Very good, because they said more likely than not means there is a 50-50 chance that any one of the amount may come. This is the meaning of this language. No confusion. Estimated is 50 to 50, most likely is 100, however, probability is unknown. Which method you follow? Most likely method. That means probability of 100 is more. Or wait. And most likely amount is 100. Okay, probability is unknown. The estimated amount is 50 or 250, but we know the probability of each of this. expected value method. Here we used most likely method. Here also we used expected value because most likely we cannot figure out because both are equally likely. Followed, no? 140. Okay, what they have done, since they say this is 50 low probability, this is 250 high probability, this is most likely 50-50, but we don't know as a probability of each. So we say that all are equal. It can be 50, 100 or 250. What is the probability? 33%. Interpretation, you can interpret it like this. Somebody can take an assumption 100. Somebody say 133. Both are okay, depending upon what assumption you have given. Are you clear? Here they are telling, I don't know the probability, so I'll give equal probability. In the first instance, what did you do? You gave 50-50. Why? Because you didn't know both the probability. Both are equally likely. Jupiter Limited is a leading manufacturer of steel furnace having carried the balance sheet 31st March 2011, 250 lakhs. What is this 250 lakhs? Book value. As at the date, the value in use and fair value is 200 lakhs. Oh, both are same. So what is your recoverable amount? 200, whichever is higher. But the cost of disposal is 13 lakhs. So what is your value in use? 200. What is your fair value? Less cost to disposal. Fair value minus 13 lakhs. 187. What is your recoverable amount? 200, whichever is high. Understanding, Prithvi? Getting, no, students? Understanding this? So calculate the impairment loss to be recognized. I said important question of this study material because in examination they may use analyze or I don't know what verb they are going to use for this question. This question looks very simple, but you have to write one theory for it. Because if it comes for 6 marks, chalo, worst case same verb came in for 6 marks. Tell me, for doing this calculation, how much mark you will assume? 2 marks, no? Then where that 4 mark is going to come to you? What theory? Now I will show you theory. Please practice this theory very much. See, first of all, 2 marks question, so they will not ask only. Till now in FR, they have never asked. If they ask you 6 marks, by looking at the question, you should know that calculation is not worth more than 2 marks. So balance, you have to write theory like this. So 50 is the impairment loss. 200 is the book value. 200 or 187, whichever is high is the fair value, recoverable amount. 50 is the book value. You have to say how you are going to account it. So we are going to recognize this in P&L account immediately unless it is revalued. An impairment loss of a revalued asset will be considered as a revaluation decrease. That means if this asset is revalued and revaluation surplus is sitting in OCI, you will reduce that from the revaluation surplus. See, this is the theory you have to write. If you simply write some other story, no, you will not get 6 out of 6. That's why this question you have to remember, and at least one day before exam you have to practice this. Recognition of the liability. If the impairment is greater than the carrying amount of the loss, you should recognize the liability as per 37. That ship example I told you. Depreciation. After depreciation, impairment, the depreciation will be on the revised amount. On which amount I should charge depreciation going forward? On 200. Why? Because this impairment is going to reduce your book value and going forward you will charge from the revised amount. Is there a deferred tax? Yes. An impairment loss recognized, you have to recognize related deferred tax. Why? What is the tax base of impairment? 0. They may say that only when you sell, I will recognize. Your book value reduction, I will not. So you have to compare it with the tax base. They didn't give any number. Chalo, for example, what is your book value at the beginning of the year? 250. What is your tax base? Say for example, how can asset can have a tax base 0? General assumption is 250. First time use purchased. Like for example, depreciation is not even charged. Less impairment you do, 50. Is this permitted in income tax? No. What is your book value at the end of the year? 200. What is your tax base? 250. Do you have deferred tax asset or liability? I told you by looking at it, you should grasp it immediately. Other perspective, you have got a deferred tax asset. Why? Because this is an asset and the carrying amount is less than the tax base. But see, that's all we didn't calculate here. But we explained the theory related to one calculation. That's why, since in the suggested answer they gave all these things, I will treat it as an impairment and an odd solution. Because question is very silent, no. Have they told in the question, write all this analysis? No. But what I tell you every time, in examination, they will twist this question. Yes, this question we can see later, okay, after certain thing. Okay, we can solve some examination questions. These are all theory, no? Okay, so how we are going to solve the problems? We are going to solve the problems impairment of the individual assets, which just now we did with one example. Very simple, no? Then we will do impairment and revaluation. Theory is not there, but we will do. If revaluation is there, how it works. Impairment of CG is a very important concept. We will understand it. Reversal of impairment is also important concept. Good exam questions are there. Goodwill impairment is super important. Nice, grossing up. Initially there was only one question when this syllabus started. Eventually 3 to 4 questions are there on the grossing up of the impairment. Okay, so we will see this and we'll start with the question number 1. Okay, on 31st March 2011, XYZ Limited makes the estimated cash flows for an asset which is located in USA as below: $80, $100, $20. Now, following information is given. Applicable discount rate in India is 15%, USA is 10%. Exchange rate at the end of the year is 45 rupees. Now, expected exchange rates are so and so. Next year, next 3 years. Now, what is your value in use? Okay, so see, that's what I told you. Now, somebody looking at this question, they say there are 2 approaches. That is called a home currency approach. Should I follow home currency approach or a foreign currency? Then why did they give me this? Confused, exactly. This has got no relevance here. Okay, so we are not going to convert. We will do first, find the NPV first, and then we use the spot rate. Followed, no? This information is simply given to you students, so don't get confused. They may use different language also in examination, but you should take one stand that this is correct. Okay, can you please pause the video and calculate the value in use, which is nothing but the present value of the future cash flows? Oh, first question only you have to do, no? Yeah, since it is all, I'll share this. Yes, sure. So it's a very simple problem. It's a basic problem. So you will plot the year cash flows, multiply with the present value factors at 10%, US rates, find out the discounted cash flows 170.40, multiply with 45, you get 7668. Understood? When the foreign exchange rates are given. Okay. Nice question to calculate the RTP. And when I saw this question, no, I just got connected to my company work, same work. Now, East Limited owns a machine used to manufacture the steering wheels, which are sold directly to the car manufacturers. Okay, there is one machine. Okay, what that machine does? Manufactures the steering wheels, and these steering wheels you sell to the manufacturers. You purchase the machine on 1st of April at a cost of 55 lakh rupees through a vendor financing arrangement in which interest is charged at the rate of 10% per annum. Clear? Now, that means I have to pay interest now. EMI basis, I must have purchased it. During the year ended 31st March 2013, East sold 10,000 steering wheels at a selling price of 190. So maybe 2 years, some arrangement was going on, God knows what was happening. I started to sell from 31st March 2013. The most relevant budget provided East management covering the period from 2013 to 2018. That means probably they told you from 1st April 14, 15, 16, 17, 18. Next 5 years projection they got now. Including the expected to sell each steering wheel 200 rupees for 13, 14. And the price is going to be increased by 3% per annum from thereafter. So if I to look on 31st March 2013 like this, I will draw some 5 years. I will first find what is my revenue next year. Today my revenue is how much? 10,000 wheels at 190 rupees. But next year it will be 200 rupees into maybe probably 10,000 wheels. Or I don't know how many wheels. How much you expect to sell next year? 10,000 wheels. And the number of forecast increased by 5%. That means my every year, next year I will say 10,000, then 10,500. So wheels are going to increase for next 5 years. Price is also going to change now. When I multiply selling price with the number of units, I am going to get sales. Now during the year, East estimate that each steering wheel is going to cost you 160 rupees to manufacture, 110 variable, 30 fixed and 20 transport cost. Now if I minus, similarly I will find out the cost every year. If I minus it, I get EBITDA, cash flows. Then the costs are expected to raise 1% every year and 2% from there onwards after next year. I have very good flavor of international financial management question. Same thing, similar thing you are going to do there. During FY 6, machine will be subject to regular maintenance costing 50,000. Are you supposed to consider this? Maintenance? Yes. This is cost, no? But without this, your asset will not be able to use now after some time. You will not make a provision right now. As per Ind AS 16, this is like an overhaul. But is it a cost outflow going to happen? When you plan value in use, should you consider this? Yes. I told you, what you should include, what you should not include. Now 13, 14, you expect to invest in a new technology, that means next year, and this technology will reduce the cost from 110 to 100. Already you have taken this cost here 160. Out of this 110 is a variable cost, and if you invest in the new technology, that is cost is going to come to 100. And fixed overheads will come here, subject to the availability of technology which is still under development. That means you are not even committed, you don't know. Don't consider this. Others people would love to tell that, oh, in 2030 one new technology is going to come, my cost is going to reduce. East is depreciating the machinery using SLM method over 10 years life. The current estimate is based on the similar asset leased at the end of the useful life of the disposal, and they are going to get 80,000 from the disposal. Should you consider? Yes. This is the cash flow, like capex disposals. East has determined pre-discount rate to be, pre-tax rate to be 8%. This is what I want. Tax you ignore because you have taken pre-tax rate. What is the value in use of the machinery as per Ind AS 36? Simple. Okay, so this question they may ask you with some other plug and play. Okay, so just I'll discuss some theory. If this question comes, you have to tell in theory. Okay, we'll do the calculation. Theory is available here. Okay, I'll just skip the theory. You say that calculation of the value in use includes the projected cash inflow and the outflow. How to calculate value in use? For this, you have to calculate the projected cash flows, inflow and outflow, and you have to discount it by appropriate discount rates. Also, you should include 80,000, but cash outflow includes expenditure of 50,000 rupees. What is that? What you call maintenance. No, in exam they may say capital expenditures. Yes, whatever it is, you have to include it. And that scrap also you should include it, but you should not include receivables, payables, that finance cost 10%. You have purchased this machinery on EMI, no? EMI will have finance cost. No, that you should not consider. Okay, so this is what you explain. Cash inflow, outflow from financing activity should not be there. Income tax should not be considered because you are using pre-discount rate. So one small theory you will explain first, depending upon how many marks this question has come. And if they say analyze and compute, then you are going to explain this theory. If they simply say in the examination, what did they say here? What is the value? See, has it told you any verb? No, but in the examination they say analyze what is the value in use, or advise value is the value. In that case, you have to explain this theory and then you have to do the calculation. Follow, no? If at all they say calculate the value in use, straight away write the heading calculation of value in use. Understood the difference? Okay, one more thing. What is the difference between old syllabus and new syllabus? Everybody will say it's the same questions, same thing, correct? But one thing I observed, the difference is, previously in the old syllabus study material, the question is, what is the value in use? In the new syllabus, advise what is the value in use. But they have not done consistently for all the questions. Some of the places they changed, they started using the verb, which is a good sign. At least we can learn. Previously they were keeping us in dark. By looking at the solution, I should make an assumption, oh, probably they may use this verb. But right now, okay, fairly good understanding they have given. Followed, no? So we will not write the theory. Theory is there in my chart book. I am going to share this also. This theory you have to write depending upon what verb they ask. Okay, write the calculation of value in use. How many columns you need to have? And when do you need this value in use? 31st March 2013, because impairment testing right now you have to do. Financials are closing on 31st March. For this, you have to value in use for next 5 years, because the life may be more, but you cannot see as year goes, estimation becomes difficult. So you have got 13, 14, 14, 15, 15, 16, 17, next 5 years. So what is your cash inflow? For this, what is the quantity? In 13, 14, how much units you are going to sell? 10,000. 14, 15? Yes? 10,500. Don't miss that information. They said it's going to increase by 5%. Next, 11,000, 25, 11,576, 12,155. Followed, no? Are you clear? If it was same constant every year, then why I should do this exercise? Straight away I would have done cash inflow, no? Why I am spending time? What is my MRP, market selling price, or estimated selling price, ESP? 9, 10, 13, 14, 200 only. 14, 15. Others, did you get that number? I want everyone to get that number, yourself, because I am here not to solve. You should solve, no? I am just here to guide you how to solve, why to solve. Got 206? Why? Because the inflation. They said, no, you are going to increase that. How much is 5, 6? 212, 219 and 225. What did they say about the market price? Market price is going to raise by 3%. Multiply A into B, you get a cash inflow. How much? 20, because you said here rupees in lakhs. Alternatively, exams they may ask you, please provide the values in rupees in lakhs. So tell at the header only rupees in lakhs. 20 lakhs, 21.63, 23.37. Is there any other cash flows which is going to come to you? Scrap sales. So scrap sale or disposal value when? Last year. How much? how much is my scrap sale? How much I should write here? Tell me in numbers. There is a sale of scrap, no? This asset, last para you see. You are going to sell this asset at a scrap value, 80,000. But how do I write here? 0.80. Followed, no? That's what we'll do at the end, no? Why I have to do individually? I will take the total net, and should I take the present value of inflow and then separately present value of the outflow? No, I will say net cash flow, take the present value of it. So you got the total inflow. How much is your cost per unit? Yes, Prithvi. Now, see, first of all, you are not finding this problem difficult. How do you find the problem? Okay, the problem is simple. Like, what we are doing is like a capital budgeting type of thing. Like, we are estimating how much cash inflow, cash outflow. And why we are doing it? To get one component called value in use. Why? For impairment. Standalone, this question can come as it is. Versus, they may give you more information and say calculate. They can complicate this question easily. So be strong and thorough with the concepts what we are discussing here. So how much is my cost per unit in the 13-14? 160. In 14-15? 161 point. How did you get 161? How much it comes? $162.61, no? 160 is the cost. $1.6 plus 160, 161.6. Can I say 162? Yeah, you round. See, you said 161.6. I say 162. Why I am doing it? Study material, they have done it. Doesn't matter. Alternatively, you could have taken 161.6. You got 161.6 now. How much you got in the third year? 165, because we are rounding it off. Maybe in the exam they may ask you, please round off. 168, 165 into 1% plus 165, 166.65. No, it changed to 2%. I'm sorry. Yeah, 168 here, and last 171. Are you clear, students? And again, don't go and don't ask me, sir, why we are rounding off. If you want, you can do it, but final answer I cannot match with the study material answer. How did you get 165, you asked me? No, you have any doubt? So here to here we increased 1%. From here, $162 into 1.001, I think 2%, no? From 162 into 1.002, 162 into, yeah, 1.02, 165, 2% increase. Then 2% increase, 2% increase. Okay, now you got a cash outflow. How much is your cash outflow? It is A into F, number of units sold, into this. Yeah, alternatively, I am okay with the students who are going to not round off this. But please look into the question in the exam. Total cash outflow, which is A, number of units sold, into the cost per unit. You get how much? 16, 17, 18.19, 19.44. Is there any other cost? Maintenance cost. What about the finance cost? No. What about the cost reduction which is going to happen because of the implementation of new project? No. So we have got only maintenance cost. Which year? How much? 50,000, 0.50. 0.50. So your total cash outflow will be same except this 15, 16 where you should add this maintenance. That's why if you look at this question, this is nothing, simple question. But remember theory. Otherwise, I don't think so. For this question, they should give you 8 marks or 10 marks. Is anybody can solve this? Theory, you have to understand that and look for any twist which should not happen. So net cash flow is what? You minus both present value factors at what rate? This is the net cash flow. You have to find out the present value of the future cash flow. That's it. You got the value in use. First time. Simple. At what rate you will find the present value? 8%, which is pre-tax. See, in exam, they may give you post-tax rate. We need a pre-tax. So whatever tax rate they will give you, that's others. Why they should give me tax rate there? Why they should give me? Either they have given me to confuse here, or in exam they may twist that post-tax rate they may give you, calculate the pre-tax rate. This is equal to net 70%, 100% means how much? Find out the present value factor with the 4 decimals, or they may give you also. Multiply all discount factors and say the total value in use is this. And this is exactly, students, I did it in my company. I could relate what we are doing here. It's a very simple case, but there, oh wow, you have to talk to the departmental heads there, get their understanding, get the cost estimations, any small mistakes, big amount of impairment effect. You have to be very perfect and accurate in your calculation. An entire exercise should be as per Ind AS 36. What we should include, what we should not include. Are you clear? Yes, students. So you can pause the video and copy. Next is question number 3.